And because of this very process, my family and I will never, and I mean never, have another bad financial day for the rest of our lifetime, while I'm alive and after I'm gone. And so I believe that financial power and control should be in your hands, not the banks, not some loan officer, certainly not the government, and not any temperamental stock market. So in the next 90 minutes, I'm going to take the past 13 years of time, money, and energy that I spent becoming an expert at this process. And I'm going to show you exactly how my teammates and I have helped thousands of people just like you across Canada to build your own peaceful, stress-free way of life.
My name is Liz Lamond, and I'm here today with my amazing colleagues from Ascendant Financial. Our team are immensely grateful to be coaching investors, business owners, and families on the process of becoming your own banker. When you think about your money, where have we been traditionally taught to keep our money? You likely might say in a bank. The theme of our discussion today is to be your own banker. Often when people hear that, they're not exactly sure what that means. How can I be my own banker? Well, when you think about what a bank does, it loans people money and benefits from the flow of money. What if you could be doing that yourself? When you learn a new idea, a different way of thinking about something, the old idea has to leave you so it can be replaced with a new concept. For some people, that's not easy. I mean, look what's happened in 2020 when the pandemic hit North America. People have had to rearrange their whole way of thinking. And look at what you and I are doing right now. We're talking on a virtual communication platform. This has been an enormous change for many in just over a year. Today, you're going to be exposed to some new ideas. These ideas may change the way you look at your own investing and give you clarity on how you can level up your investing journey. I have the great pleasure today of introducing my colleague, Jayson Lowe, who is a successful entrepreneur, coach, and business person. For the last 13 years, Jayson Lowe has been helping people think a different way about their money. He has worked with thousands of individuals just like you, guiding them to become their own banker. Jayson has a unique way of making the complicated clear and the confusing simple. And there's going to be a lot of things you're going to hear today that are going to uncomplicate things, especially in your financial world. And that's what we're doing in our practice, helping people make better financial decisions. Please welcome Jayson Lowe, who is the founder and CEO of Ascendant Financial, as well as the co-author of the recently released Canadian edition of the book, The And Asset. Take it away, Jayson.
All right. Thank you, Liz. And welcome to all of our attendees. As Liz mentioned, you made a very smart decision to be here with us this evening. And so we want to extend a warm welcome to all of our Canadian attendees coast to coast. And let's dive right in. I want to begin by sharing with all of you who was R. Nelson Nash, the developer, the pioneer of this process of becoming your own banker, the infinite banking concept. And what I'd like to do to kickstart the engagement, because we're going to have lots of engagement throughout this evening's webinar, I'd like to ask all of you, and if you could join me just by engaging, typing into the chat window, and Liz, maybe let me know what you're receiving in terms of responses there. Who revolutionized the automobile industry with the Model T? Any guesses?
Henry Ford, Henry Ford.
All right, absolutely correct. Who created amusement parks and pioneered cartoon films, including Mickey Mouse? Any guesses?
Walt Disney, Walt, Disney.
There we go. All right, excellent.
Disney.
Now, who revolutionized a process to enable you to become your own banker? Any guesses?
Nelson Nash. They're quick tonight, Jayson.
Okay, good. All right. Thank you, everybody, for the engagement. Nelson often said, what a peaceful, stress-free way of life it is when you get the banks out of your life. This is a remark that Nelson made so often throughout the years that we were blessed beyond the definition of good fortune to be mentored by him. And my hope is that this evening, in addition to what you may already have discovered about Nelson, that you get an even deeper glimpse into just how amazing and what an incredible pioneer Nelson truly was. Now, by the end of this webinar, you'll know that you are capable of becoming your own banker. You'll have clarity on the problem. You'll be exposed to the solution and you'll know exactly what you can do. You're going to feel like what a recent webinar attendee had emailed to us saying, I found hope. I found a new way and a new belief in a way that I can create my own peaceful, stress-free financial life. And what is the opposite of stress-free? I always laugh at this picture every time we look at it. Everybody's experienced this. And, all kidding aside, when we think about what's happened through this global pandemic, if I take you back to March 20th of last year, and just thinking about my own teammates here at Ascendant, we got together and said, look, we have two choices. We know that this pandemic is serious. We just don't know how serious it's going to be. And we have two choices. We can either advance or we can retreat, but we can't do both. We have to choose one now. And unanimously, all of our teammates said, we choose to advance. And my response to them was simple. Everyone who's on the team today is going to be on the team next year today. And as the leader, I will eat last. Nobody's going to lose their job on my watch. What we need to focus on is serving the people. And that's what we set out to do. And last year, our business more than doubled, right in the midst of a once in a lifetime experience of going through this incredible, devastating pandemic for so many families, so many businesses. And then what we found is Canadians were reaching out to us, and there were so many people who were saving a lot of money. They weren't commuting, they weren't dining out, they weren't traveling, they were stockpiling money on the books of someone else's bank. And they had much more time with their iPhone, their iPad, the YouTubes, the Netflixes, they're out there researching and learning and discovering this process. And after our business more than doubled last year, we're 114% over last year, year to date, because of you, because you're taking action. You're choosing to advance, not to retreat. And so you're in the right spot. You made a great decision to be here. Now, we've all been told to put our money into instruments like mutual funds, commodities, stocks, bonds. In other words, you're putting your money away in financial prison, and then when you need access to capital, you have to go to someone else's bank to borrow it and to gain access to it. And you can all agree, just give me a yes or a no in the chat window, a Y or an N for no. Has your experience over the years been favorable in dealing with banks and third-party lenders when you need ready access to capital? Liz, let me know, what are we getting in the chat window?
No, with exclamation marks, lots of N's, lots of N's.
And so there's no.
Oh, there's one yes.
Oh, okay. Yeah. Hey, there is the occasional yes. But people are sick and tired of the financial system. Now, they can't quite put their finger on what's going on and what's happening, but the feedback that we're getting every single day with Canadians that we're connecting with is that they're sick and tired of it. They're sick and tired of having to jump through lengthy, nosy credit applications, having to hand control of their money over to someone else who thinks that they can do better with it than they can, having to go through the toll takers and the gatekeepers. It's completely absurd. And I'll tell you that if you've been handing your money over to someone else who thinks they can do better with it than you can, you might not be in the best situation right now, but it's not your fault. Are you committed? I want a response from every one of our attendees who's with us here this evening. Are you committed to discovering becoming your own banker? Y for yes or Y for yes?
Lots of Y's, all Y's, yes.
Perfect. Are you willing to commit to improving anything that you're already doing financially that is preventing you from becoming your own banker? Y for yes or Y for yes?
You're giving them many options. Yeah, still lots of Y's, Jayson.
All right. Well, welcome to Commitment, and we hope that you enjoy your stay. I want to share something with all of you that's very personal and very impactful because it helped me to decide to advance. And I want to share with you that personally, I discovered the path to a peaceful, stress-free financial life the hard way. And what came up for me in preparing to share this with you is that I truly believe that each and every one of you deserve a life of no regrets. And I'm going to take you back to September 2006. And it was about 7 o'clock in the evening, not too much later than it is right now. And I was in Sherwood Park, Alberta, standing in this dark, empty living room. And I was staring out at a sold sign on the front lawn. Now, I want you to be my invisible partner standing right next to me in that dark, empty living room. I was feeling like a failure. I was feeling stressed and defeated. I would never have expected to be here after doing all the things right financially. How is it possible that doing everything right got me here? A few years before that, I was 30 years young. I was married. I had a mortgage. I was very ambitious about my future. And up to that point in my life, I was doing all the right things according to mainstream financial advice. And over the course of the next few years, life decided to hand me several big challenges all at once. My marriage ended. I was deeply in debt. I was on the brink of financial ruin, and I endured the unexpected passing of both my mom and my dad. Some of the most stressful events that you can experience over a lifetime happened to me in just a few short years. Standing all alone in that dark, empty living room, I didn't know who to turn to for help. And if you were in that same situation, what would you have done? Just when I felt like I had honestly hit rock bottom financially, I remembered something that my late dad used to say to me, God rest his soul. He would say, son, don't ever be found guilty of giving up on yourself. And that's when I made the decision to take action. And it was in 2008. I was contacted by a dear friend of mine, Matt Lovelady, and he was a successful and established business owner and still is to this day. And he invited me to attend an event. And the topic of that event was what I later learned to be the process of becoming your own banker, the infinite banking concept. Now, I didn't have any money to go to that event, but determined to find answers, I decided to do whatever it took to get there. I took action and I decided to advance. I left that conference feeling that everybody should hear about this process, and that's why you're here this evening. I began to implement this process in my own life personally, and everything changed for the better. Fast forward to today, I'm remarried to my intelligent, beautiful wife, Rebecca. We have 4 young children. We no longer feel stressed financially. We're in total control, and I'm no longer worried about money, and certainly no longer worried about the ups and downs of a stock market or government change or intervention. And because of this very process, my family and I will never, and I mean never, have another bad financial day for the rest of our lifetime, while I'm alive and after I'm gone. And so I believe that financial power and control should be in your hands, not the banks, not some loan officer, certainly not the government, and not any temperamental stock market. So in the next 90 minutes, I'm going to take the past 13 years of time, money, and energy that I spent becoming an expert at this process, and I'm going to show you exactly how my teammates and I have helped thousands of people just like you across Canada to build your own peaceful, stress-free way of life. Does that sound good? Give me a thumbs up. Give me a yes in the chat window. Let me know if you're ready to go.
Yeah, lots of sure does. Thumbs up. Yes, yes, yes.
Excellent.
More thumbs up.
Excellent. Thank you, Liz. All right. Let me share with you this. You know, most people believe that they need someone else to take care of their money. Have you ever experienced that? Has anybody ever shared that with you? Most people believe that it's necessary to risk their money in order to grow it. Most people know next to nothing about the process of banking and its importance to their lives, their well-being, and to their livelihood. Here's the truth. The difference between you getting stressed or staying relaxed financially is who controls the banking function in your life. And someone must perform that function. You don't have to put your money away in financial prison for decades and then rely upon someone else to achieve the financial abundance that you deserve today. You don't have to be rich to become your own banker. A colleague of mine in the industry, Brent Kessler, with the Money Multiplier, he shares this often. He says, whether you're making $10 an hour or whether you're making $10,000 an hour, this is a process that you need to discover and that you need to embrace in order to create financial abundance for your family your business, or both. Now, who is this process for? I'll give you one guess. You. Everybody banks. The distinction between some people and others is whether or not you're controlling the banking function as it relates to your needs. So ask yourself this question: who is the banker in your life today as it relates to your needs? I want to share with you a little bit about how the concept, the process came to be. I'm going to take you back all the way back to the early 1980s when inflation skyrocketed. And Nelson Nash, the developer, the pioneer of this process, he found himself in a real predicament. Interest rates had peaked at 21.5%. Nelson found himself in a position where he owed $500,000 in mortgage debt because he was quite involved in real estate investing. Now, there were so many financial gurus who were talking about how incredibly simple it was to utilize leverage and to go and buy real estate using the bank's money. And nobody talked to Nelson about what would happen if the interest rate lever went in the other direction. And it did. Oh boy, it put him in a bad spot. One of his joint venture real estate partners actually filed for bankruptcy. And Nelson knew that it was his option to also file for bankruptcy. He chose to advance. He didn't choose to retreat. Now, what he felt was that, look, I don't know how to get myself out of this situation. And people were telling him, Nelson, just sell the real estate. And he thought to himself, what fool is going to buy this real estate from me, knowing that they have to finance it at such high rates of interest? What Nelson didn't realize is that he had the solution to the problem right in front of him. Now, after a lot of careful thought, he referred to it as the 2x4 moment. It was like getting hit across the face with a 2x4 when he recognized that the solution was right there in front of him. He had, at that point, already built up a system of dividend-paying participating whole life insurance contracts. He had access to money from the life insurance companies at 8% to pay off the snakes and dragons at 21.5%. It took him and his wife, Mary, 13 years to get rid of the banks permanently. And afterward, him and his wife, Mary, did not see a commercial bank for anything other than the convenience of debit for the rest of Nelson's lifetime. Now, sadly, Nelson passed away in March of 2019, and his wife, Mary, is still with us today, and she will never have another bad financial day for the rest of her lifetime. And remember that joint venture real estate partner that filed for bankruptcy? Nelson owned a life insurance policy on that joint venture real estate partner. And when that real estate partner passed away many years later, not only did Nelson recover all of the money that he had to pay to get himself and his partner's interest out of a jam, he was able to replenish all of that money. It all came back to him on a tax-free basis. Isn't that good? Everybody needs a heart. Would you agree? Go ahead and type in the chat window. Yes, everybody needs a heart. Now, I want to share a story with you about Nelson. Many years ago, Nelson had to have his own heart replumbed in 4 different places. So he was obviously under anesthetic, and he doesn't remember the experience of having to go through that surgery. And what he remarked about it is he said, look, the only thing that was keeping me alive while I was in surgery was a heart and lung machine. And during that period of time, I wasn't truly living, I was only existing. And it was the heart and lung machine that was keeping me alive. Now, if you think about this analogy as it relates to you and to who controls the banking function in your life, you're being kept alive financially on the equivalent of a heart and lung machine because you're relying upon someone else's bank, someone else's system to meet your needs financially. And it doesn't have to be that way. You're going to discover a better way this evening. Now, we understand that banking is the most important business in the world. Without it, everything comes to a screeching halt financially. The banking system, much like the heart and lung machine, the banking system pumps the money in to the system where it's needed the most. And then at some point, It flows through your hands and mind. Think about how you earn income and where that income flows to. And when you're buying food and paying the bills and taking vacations, buying a business, expanding a business, all of those things, investing, where does the money all end up? Right back on the books of someone else's bank. I say that again, someone else's bank. Now think about this. The real issue here is how much of this function do you control as it relates to your needs? I want you to know that there is only one pool of money on the planet. It's inconsequential that there are many different financial institutions. There are many different currencies. There is only one pool of money on planet Earth. And what Nelson saw is that he was pumping money into the pool the wrong way. He had to go through the bankers, the toll takers, the gatekeepers, who were all making money off of him and abusing him. Has this ever happened to you? Go ahead and type in the chat window a Y for yes or an N for no. Liz, what are we seeing?
Lots of yeses.
Thank you. What Nelson realized is that he needed to crank up even more large life insurance premiums inside of his dividend-paying participating whole life system of policies in order to get the bankers out of his life for good. And you cannot get that done overnight. Presently, in today's world, we live in an instant gratification everything. Instant food, instant coffee, instant delivery. This has to be done incrementally over a period of time. It cannot be achieved overnight. Nelson's own wife, Mary, thought that he was crazy. And what they were able to achieve certainly changed her opinion of that throughout the years and for the remainder of Nelson's lifetime. It's important here to understand, in addition to everything I've already shared, is that there are only 4 characters in the financial play. Now, most people out there have no idea that the play even exists, and let alone getting the characters all mixed up. I want to share with you who these characters are, and I'd like you to commit these to memory as we go through the rest of tonight's webinar. The first character in the financial play is the depositor. The second character is the borrower. The third is the banker, and the fourth is the bank owner. Now, for most of you on tonight's webinar, you are only 2 of the 4 characters in the financial play. When you earn income, that income is deposited onto the books of someone else's bank. When you need access to money, even when you pay cash for things, you're also the borrower. You're always working with borrowed money, even when you pay cash for things. The third character in the play is the banker. This is the individual who determines what criteria needs to be put into place and who gets access to the pile of money that belongs to someone else. And the fourth character is the bank owner. Think of this character, for example, as the stockholder of a commercial bank. The bank owner is the character in the play who has an expectation of profit and participating in that profit. The banker is the character in the play who gets to make the most money. So if you're only 2 of the 4 characters in the financial play, you made a real smart decision to be here, because you're going to discover how to become all 4. Most of you have heard at some point in your lives, I'm sure, the phrase, the golden rule. And that means those who have the gold make all the rules. And people have abdicated their responsibility and, more importantly, their opportunity as it pertains to the banking function in the economy. They're depending on someone else to perform that job. And that character in the play is making most of the money, and rightly so, because of the golden rule. The person on the street in Canada understands the subject so poorly that he's doing the equivalent of living off of a heart and lung machine. Something to think about. What I want to talk to you about is how to take control of this function as it relates to your needs, how to create the system in which you can control the banking function. Now, this book, Becoming Your Own Banker, if you have not read this book, please type into the chat window N for no. Liz, are we getting any N's for no?
Yes, we are, Jayson. We're getting a few yeses, but mostly no's.
Okay, now you all have an opportunity, and there's going to be a text message sent to you, an email, a combination of the two. and you're going to receive a link where you can purchase a copy of Nelson's book. Now, we sell it for cheaper than Amazon. We ship it anywhere in Canada. It's a 92-page read. You can get it done in less than an afternoon. And this is the book that changed everything for me and for all of our clients who are implementing this process. Now, it sold over 470,000 copies across the globe. Why? Because it works. This process works. And when you get your copy, I want you to think about someone who you care for, who you believe would benefit from the gift of a financial transformation such as this. Get a copy for them. Get it in their hands. One read of this book will open up your eyes to a whole new financial world, I promise you. Now, the very first principle that must be understood is that you finance everything that you buy. You either pay interest to someone else to access their pile of money, or you give up the interest that your money could have otherwise earned. I want you to think about this for a moment. When you have cash and you've saved up this cash on the books of someone else's bank, and then you spend it to purchase whatever it is that you wanted to set out to buy, you cannot use that money ever again. You've permanently transferred it away from you, from your family, and for every other generation that comes after you. That's called lost opportunity. You made the choice to permanently give up the opportunity to earn interest on that money for the rest of your lifetime. And conversely, when you borrow money from someone else's bank and you repay that money in the form of principal and interest, you're paying a cost of capital. You're paying a cost called interest in order to access someone else's pile of money. Both methods involve a permanent transfer of money away from you. We want to change that. But I want you to know, I want to be clear, there are no exceptions. You either pay up or you give up. There are never any exceptions. The whole idea, the whole essence of the process of becoming your own banker is to recapture the interest that you're presently paying to banks, to finance companies for all the major items that we need throughout our lifetime. And the objective is to keep that money flowing back to your family. A fatal error of this concept is that it has something to do with interest rates. This is all a matter of where the money is flowing to and who that money is being put to work for. The question I have for you is, how much of the banking function do you control as it relates to your needs? I think we can all agree that our money must reside somewhere. You may be storing money today in a variety of different places. You may have money stored in registered retirement savings plans, in registered education savings plans, inside of mutual funds, stocks, real estate, bonds, precious metals, the Bitcoins and the Crypt coins and the Doge coins and the Ball coins and the Parrot coins and whatever cryptocurrency that you may be investing in. The fact of the matter is that your money must reside somewhere. And someone has to perform this function of banking as it relates to your needs. And I'm here to tell you that it should be you. Now, I do want to say that this process is not an either or. It's not a, should I become my own banker or should I put my money into real estate? Should I become my own banker or should I invest in the stock market? Should I become my own banker or should I put my money in Bitcoin or gold, silver, etc.? This is an either, not an either or, this is an as well as. Because regardless of whatever it is that you're already doing financially or whatever it is that you're even contemplating doing financially, if you're not controlling the banking function as it relates to that thing that you want to do financially, then you're at a disadvantage. Becoming your own banker is not about addressing the yield of an investment. It's all about how you go about financing the things in your life, which can certainly include investment. I'm going to talk a little bit about getting into the grocery store business. Now, you may be thinking to yourself, what on earth why are we talking about the grocery store business? I'm here to learn about becoming my own banker. When you grasp and understand this grocery store example, the rest of becoming your own banker is a piece of cake. And so follow along and let's see if we can get some engagement going here. Now, let's envision for a moment that you're going to get into the grocery store business. So I just want you to pause for a moment. I want you to picture yourself getting into this business. Now, you recognize that this is a business where you are both the consumer as well as the seller of a product. Everybody needs food, and most of us purchase our food from our local grocery store. And think about this as it relates to the process of banking. You're both the consumer as well as the seller of money. Now, your market's unlimited. Everybody uses groceries, and someone has to perform the function of distribution. Now, we're going to study the business for a period of 2 years before we open our doors. We're going to purchase a superior location. We're going to build a really attractive building. We're going to stock it with really high quality merchandise. Now, up to this point, how much money have we made in our grocery store business? Go ahead and type it into the chat window. Now, we've had to put a lot of capital up, right, to get the building, to get the shelving, to hire the people, to put the cash registers in place, to do all those things. And up to this point, how much money have we made?
Zero, zero, nada, zero, zero.
You got it.
Nil.
You must turn the inventory. So once you open the doors, you've got to turn over that inventory 15 times just to break even. And if the money, or the food rather, if that's not moving, so imagine if the bread doesn't sell, the milk doesn't sell, the butter doesn't sell, the eggs don't sell, the food's going to rot. So we have to keep that inventory in constant motion, because the customers who are coming into our grocery store have an expectation that it's going to be stocked with high quality merchandise. If you turn the inventory 17 times over, you're going to be profitable. If you can turn it 20 times per year, you can retire early. So in other words, don't let your capital sit still when you implement the process of becoming your own banker. Money, much like food, money that isn't in motion isn't worth anything. So when you think about getting into the grocery store business, I also want you to think about becoming your own banker, because you're cranking up a business that didn't exist before. This is all about taking control. Now, let's use the analogy of a can of peas. And you're going to hear me use the expression, don't steal the peas. Here's what we mean. Let's envision for a moment that we purchase a can of peas from the wholesaler, and we purchased it and we can sell it at retail for 60 cents. We bought it from the wholesaler at 57 cents. The difference between those two is our margin. That's 3 pennies. Now, I want you to envision for a moment that you're the owner of the store. Now, you have the ability to either go through the front door. So when you need a can of peas, you can walk through the front door, go to the shelf, take the can of peas off the shelf, go to the cash register, and you can pay retail just like your customers do. Or you have the option, because you're the owner of the company, you're the one that calls the shots, you can walk out the back door with that can of peas. Now, how many of you would choose the front door, and how many of you would choose the back door? So just F for front or B for back. Go ahead and type it in the chat window. What are we getting, Liz?
We are getting lots of Fs.
Excellent. That's good. That means that you're an honest business owner, because if you walked out the back door with the can of peas, your employees are going to see you doing the same thing. Think about this as it relates to becoming your own banker. If your family sees you stealing the peas, where you're accessing policy loans, you're not repaying them, you're going out the back door with the money, your family's going to see you doing the same thing, and they're going to repeat that behavior. And so one of the things that I often hear is that your children will mirror your behavior. Well, I keep my room pretty clean, and my darn children are certainly not mirroring that same behavior. So it's not true. It doesn't apply to everything. But as it relates to financially, you can bet your bottom dollar it certainly applies. And so if we go out the back door with just one can of peas, we know that we can sell it at retail for 60 cents. And we walk out the back door, we have to sell how many cans of peas to make up for that one can that walked out the back door? Any guesses? Type it in the chat window. How many cans of peas do you think we need to sell to make up for the one can that walked out the back door?
20.
That's the right answer. You got it. Now, as the owner of the business, What if you could put a few extra pennies into the cash register, and rather than pay 60 cents, you pay 62 cents? You're putting a little bit more capital into your own business. And what can you do with that additional capital? You can purchase more shelves and you can stock it with more cans of peas. No grocery store owner is going to object if there's a demand for peas and they can stock more cans of peas on the shelf. No grocery store owner is going to object to that. So remember, as this relates to becoming your own banker, the more capital you put into your own system, the better it is for you and for everyone else who co-owns the grocery store with you. So think about this. Don't steal the peas. I want everybody to remember that. Super important teaching moment. Don't steal the peas, but you have to go through the process of setting up the business. You have to go through the process of training, getting to know the business. Once you open the doors, you got to make sure that even you as the owner, you're shopping at your own grocery store. Let me ask you this question. If this grocery store was a Safeway, would you ever buy your food from Walmart again? Type a Y for yes or an N for no in the chat window.
Never. No.
Right, because you want the money flowing through your business, not through someone else's. Once you understand the grocery store example, the rest of this process is a piece of cake. But remember, don't steal the peas. Now, we got to frame up the problem, because if you don't understand the problem, the solution just won't matter. Here's the problem. Who is the banker in your life today? You're earning an income. It could be dividend income, interest income, T4 income, a combination of all the above. Your income gets deposited into someone else's bank. I say that again, someone else's bank. The money sits there waiting for you to pay your bills. Now, do you honestly believe that the bank is letting your money sit still? Not a chance, because your money that's on deposit with the bank is a liability to the bank, not an asset. It's referred to as an on-demand deposit account. Now, many of you may not have realized that the moment that that money shows up in your checking account, it's no longer your money. You just became an unsecured creditor of your bank. Your bank is going to put that money to work for the benefit of the stockholders. Remember the four characters in the financial play: the depositor, the borrower, the banker, and the bank owner. You're still only the depositor and the borrower. When you pay the bills, you're permanently transferring that money away from you. That, remember what I said about you either pay up or you give up. Well, in this case, you're giving up because you're transferring the money away and you're permanently losing the opportunity to earn interest on that money for the rest of your lifetime. And whenever you earn that income and then you start spending it on all those things that you need for your household or your business, you are doing all the darn work and everyone else is getting all your money. How does that make you feel? Please type in the chat window. How does that make you feel? What are we getting, Liz?
Fractional. Frustrated.
Okay. Very common. Yeah. Very frequent response that we get is that people feel frustrated.
The down face.
Now, I want you to think about the debtor. This person sees the interest because it's part of their payment. So think about when you borrowed money to buy a car, you borrowed money to invest in real estate, you borrowed money to buy your home, you borrowed money to buy a business. You're the debtor and you see the interest component because it's part of every payment that you're making. Now think about the debtor. This is the person who borrows money from someone else's bank. It's a structured loan, so they have to make payments of principal and interest every single month back into the books of someone else's bank. By the time they're done making the final payment, they're right back at zero. They have to go and borrow money again. They make principal and interest payments back to someone else's bank. So every payment that they're making is a deposit into someone else's bank, and they end up right back at zero. And I want you to contrast that for a moment with the saver. The saver, who's someone who does not see the interest because they're giving up the opportunity to earn interest on their own money. The saver is the person who stores or stockpiles money on the books of someone else's bank When they have enough money to purchase whatever it is they needed, they withdraw all that money. They're right back at zero. They accomplished their objective of purchasing whatever it was that they needed, but they permanently transferred all that money away. Now, my question to you is, what's the difference between the debtor and the saver? They both end up at zero. So don't be the debtor and don't be the saver. Be a wealth creator. And I'll expand on that here in just a moment. It's a very powerful aha moment when people realize that there is no difference between these two, the debtor and the saver. They both end up at zero. Every deposit made, every payment made is a deposit on the books of someone else's bank. Every deposit you make into your savings account is a deposit onto the books of someone else's bank. I think you can follow where I'm going with this. Both methods involve a permanent transfer of money away from you. Every payment that you make is a deposit into someone else's bank. The solution is the process. Remember, your money must reside somewhere. So we're going to go through a fun thought experiment, and I'd like to involve all of you. If you can invent the type of asset, now you're inventing this from scratch. You have a clean slate. Now, the only criteria is that this asset can have absolutely no drawbacks whatsoever. I want you to describe to me what it would look like. Now, to get this thought experiment going, I'll share with you what are the most common attributes that people tell us about this perfect asset that can have no drawbacks. One is a high rate of return. That's a very frequent response. The second is a consistent rate of return. The third is that it's conservative. Now, I'd like you to share in the chat window what other attributes this perfect asset would have if you could design it from scratch and it could have no drawbacks whatsoever. Go ahead and type into the chat window.
Tax-free.
Tax-free. Okay, very good. Thank you.
Tax-sheltered.
Tax-sheltered. Very good.
Secure.
Okay, secure.
Liquidity.
Liquidity. Okay.
No fees.
No fees. All right.
Safety.
Safety.
Compound growth.
Compound growth. Very good. Thank you. All right. Let's see if there are a few more, Liz, coming in.
Need to get people's fingers typing. Zero risk.
Zero risk. Okay, let's get one more. Out of all of our attendees, surely we've got one more.
Generative, creative of value.
Okay, excellent.
Dividend paying. There you go. You got two more.
Okay, so let's see what the most frequent responses have been to the creation, the attributes of this perfect asset that we've received every time we go through this experiment. Here are the most frequent responses. Liquid, guaranteed, tax benefits or even tax-free, no market volatility. It yields income besides capital gain. It's creditor protected. It's inflation protected. You have total control. It's transferable. It's easy to manage. There's no hidden fees or penalties. It's reputable and private. Now, what I'd like for everyone on tonight's webinar to do is for your own various assets, I'd like you to simply identify from which features from this list that your existing assets do well on and which features they simply fail to satisfy. Take a moment to think about that. Think about all of your current assets. Look at this list of attributes and identify which of the features from this list that your existing assets are doing well on and which of the features they simply fail to satisfy. Now, I will say, I've got a surprise for everybody. That list of attributes most accurately describes a participating dividend-paying whole life policy. I want you to understand a little bit more about the tool. A participating dividend-paying whole life insurance contract. What exactly is that? What are the attributes of this tool? It's participating, meaning you become a part owner of the life insurance company and you participate in the profits generated from every line of business that the insurance company operates in. Now, this is an opportunity to become a co-owner of a business that has never failed to be profitable since inception. And in Canada, that inception was in 1847. So if you can become a co-owner of a business that's never failed to produce profit and has been operating for that length of time at maximum. How much capital would you want residing there? Now, dividend paying means that each year the life insurance company declares a dividend. It is contractually guaranteed to be paid. I say that again, contractually guaranteed to be paid to the participating policy owner, and it can never be repossessed and it can never lose value. Whole life means that you're insured for your whole life, all the way to age 100. And one of the many contractual guarantees that the insurance company itself is legally bound to fulfill is the total cash value of the policy must equal the total death benefit by age 100 of the life that is insured. That means that every single day that you are aging, the total cash value of the contract is rising and it cannot go down. It's not tied to stock market performance. It's not tied to real estate market performance. It's not tied to the economy. It's not tied to any pandemic, certainly not tied to any government intervention. This is a unilateral binding contract. It is not an investment, never has been, never will be. It's a unilateral binding contract that is guaranteed to rise in value every single day. Isn't that good? Give me a heck yeah in the chat window if you think that's good.
Yes, heck yeah.
All right.
Yes.
It's pretty safe to say that we don't have many financial guarantees in life anymore, that's for sure. Pensions are going by the wayside. There's doubt about the future. However, this contract, this dividend paying participating whole life insurance contract, creates peace of mind, and it's unmatched in its financial security. Here's how. The cash value begins accumulating immediately, contractually guaranteed to rise every single day without interruption. You've got easy and guaranteed on-demand access to a growing pool of financial value that you can use to take advantage of opportunity that will most certainly track you down. One thing that the late R. Nelson Nash used to say all the time, when you have ready access capital, opportunity will hunt you down. And he was absolutely correct. You're not penalized for accessing it early like you would be inside of an RSP or other financial products. There are several tax advantages, both personally and corporately. How many business owners do we have on tonight's webinar? If you're a business owner, just go ahead and type the letter B in the chat window. Let us know that you're a business owner. If you own and operate a company, you definitely want to become familiar with all of the tax advantages that this tool provides to you. It is exempt from the passive investment income tax rules, and it provides so many advantages to the corporation and to the corporate owner. So if you're a business owner, stay tuned. And for everyone else who's not, if you're a T4 income earner, if you're a family member in a household, you definitely need to be a participating policy owner so that from this very place, you can take control of the banking function as it relates to your needs. Now, there's a death benefit thrown in for good measure, of course, and it's paid to your named beneficiaries income tax-free. What I'm inviting you to do is to recognize that you are your greatest asset. You are your greatest advantage. So be a wealth creator. What you're seeing here in the image, this represents the contractually guaranteed daily accumulation of cash value. It can only rise. It can only go up. And when you need to finance those things throughout your lifetime to purchase all the goods and services that you need throughout your lifetime, you're going to access policy loans from the life insurance company without interrupting any of the accumulating value in your policy or system of policies. You're going to borrow against your accumulating value without interrupting the compounding growth of it. You're going to repay policy loans on your schedule, nobody else's, and everything that you repay, you get to reaccess. Isn't that good? Give me a heck yeah in the chat window if you think that's good. Be a wealth creator. That's what this process provides you with the opportunity to do. Are we getting some heck yes?
We are, yes.
All right. So here's what's entailed in creating your own system. The first fundamental thing to understand is Nelson Nash's 5 golden rules. The first golden rule is to think long range. What I mean by that is to think 3 generations past your own. Everyone's going to need the use of money, and someone must perform the function of banking. So I want you to think long range. Think about creating a family banking system. Don't be afraid to capitalize your system. The more capital you put in, the more capital you get out. It's the ultimate in simplicity. Thirdly, don't steal the peas. Everybody remembers that from earlier, right? Fourth, don't do business with banks. Every time you borrow money from a commercial bank, you are contributing to inflation. And commercial banks inflate the money supply. So don't do business with banks. The fifth golden rule is to rethink your thinking. Everything begins with the way that we think. I say that again. Everything begins with the way that we think. And there's no such thing as having arrived in knowledge. There's always something new to learn. If you believe that you've arrived in knowledge and that you've already learned everything there is to know, I invite you to hop off the webinar now, because the rest of the webinar will be of no value to you. But if you believe that you can still learn something new and that you haven't yet learned everything there is to know, you're in store for a real treat for the rest of the evening. Now let's talk about individuals and families here for a moment. I want to share with you one of our existing clients, David Klein, who's a police officer here in the city of Edmonton. He's someone who completed this class many years ago. And the question that he asked me was, can you take a look at my financial situation and help me to implement this process of becoming your own banker in my life? And I said, absolutely, of course we can. And here's what's happened with David since then. 7 years ago, it'd be 8 years now, a friend had told David about the process of becoming your own banker. And when he attended the class, he was a little skeptical. His father had worked for Revenue Canada for 30 years. And he was given the book, Becoming Your Own Banker by R. Nelson Nash. And after reading it, doing some additional research, remember, he's a police officer, so he has that investigative gene. And he attended a class, he booked an appointment, he met with me, he began to implement this process in his life. And what happened for him is that 2 years after opening their first policy, he took out a policy loan, he paid off the bank loan on his wife's Subaru, he redirected the remaining payments that he would have otherwise been scheduled to send to someone else's bank. He redirected those payments back into his own family banking system. 3 years later, so now we're into year 5 of his journey, he took out another policy loan, he skipped the bank altogether, purchased his own brand new vehicle, and children started to come along. So he took out a policy on his newborn, as well as a second policy on his own life. With 5 policies in force, 7 years now into his journey, their mortgage on their principal residence was coming up for renewal. Instead of renewing with the commercial bank, they took out a policy loan from their system, their family banking system, of 5 policies, and they paid off the mortgage in full. They're now making the very same payments that they would have otherwise been scheduled to send to someone else's bank. Those very same payments are coming back to their family versus flowing away. Their family goal was to always pay off the mortgage early, and they honestly hadn't thought more about that in terms of how they could do it before being introduced to this process. After these 7 years, they know that they have the freedom, the flexibility to do whatever they want, whenever they want, on their terms. He goes on to say, this is a feeling that I simply can't explain, but to say it's truly amazing. Now, David was interviewed on our Wealth Without Bay Street podcast. And so if you ease on over to YouTube and you go to Wealth Without Bay Street, you can find David Klein's episode, and he expands more on his experience with the process, the impact that it had and still has to this day on him and his family. Isn't that good? All right. Now, one of the most common questions that I get is, Jayson, can you connect me with the right person on your team to take a look at my financial situation and show me how to become my own banker? The answer is absolutely yes, we can do that. We have a Becoming Your Own Banker call designed just for that purpose. What you can do is you can click the link that you've received already, or you can simply pick up your smartphone and you can text the word schedule to 780-809-4599. Again, that's 780-809-4599. Text the word schedule. You can reserve a date and time that works best for you. It's included in the webinar, so make sure that you complete that experience. Now, I know, and you should know by this point, deep down, that you are capable of becoming your own banker. Here's the follow-up that you can expect from us. We are going to stay in touch with you. We're going to email you. We're going to communicate with you, and you can unsubscribe from that communication at any time. You're going to receive an invite, if you haven't already, to schedule that time to meet. If we don't hear from you, the right advisor on my team is going to extend a courtesy call to you to find a mutually convenient day and time to meet. If you prefer not to meet, simply let us know. And as long as you leave happy, that's okay too. Now, I want to share one more client testimony before we dive deeper into the solution. Alan Antonio, him and his family, they've been practicing this process for several years. Now, he heard me speak in a presentation just like this one several years ago. And when he had the opportunity to get Nelson's book, he did that. And then he began to implement this process in his and his family's life. And here's what he's been able to achieve. It truly is remarkable. And I want to share with you, especially if you're a real estate investor, this is really going to appeal to you. Now, what I want to say is that with Alan and Janet, when their journey began and they started to capitalize their system, they were putting premium into their system of policies. They had previously decided to invest in real estate, and they purchased 6 fourplex units and had a mortgage remaining on 3 of them. And when they began to implement this process, after 3 years of building their system of policies, they had accumulated enough cash value in their system that they could access a large enough policy loan to pay off the bank mortgages entirely on their rental real estate 13 years early. I say that again, 13 years early. And that was a huge accomplishment for them, knowing that they were really implementing this process as it was intended. A few years later, their oldest daughter and son-in-law, they decided to purchase their first home, and they were able to take out a policy loan from the family banking system. And they used those funds for a cash deal. They got the property, and rather than mortgage it with a traditional bank, their daughter and son-in-law are now making payments back to the family banking system and keeping up with the idea of keeping the money in the family. The infinite banking process, Alan says, is now providing financial security for us and for further generations. It is definitely a win-win-win that every person should consider. So again, just another powerful testimonial from an existing implementer of this process. Now, I do want to dive into something here, and I want to talk about how 99% of the Canadian general public goes about purchasing vehicles. Now, the significance of this, I want you to think about this as it relates to anything that you're planning to buy, whether it's a vehicle, piece of real estate, business, equipment, whatever that may be. I want to compare how 99% of the Canadian buying public goes about it. Now, each of these payment methods, they all require an ongoing stream of payments, a constant transfer of capital away. We've got the no purchase payment plan, which is leasing. We've got a post-purchase payment plan, which is financing, meaning that you don't own anything until your final payment. And we've got a pre-purchase payment plan, meaning that you're saving cash, then spending it, then having to save it again, then spend it, and so on. With each method above, who's getting all of your money? Go ahead and type it in the chat window. Who do you think is getting all of your money?
Bank and lenders.
Is that what's coming up, Liz?
Yeah, lots of bank.
People are saying the bank?
Yes.
Now, the operative words are someone else's bank.
Someone said not me.
That's who's getting all of your money. Someone else's bank. How does that make you feel? Go ahead, type it in the chat window. Let us know. How does that make you feel?
Not so good.
Here's how it makes most people feel. He's getting a kick out of this. Is that
angry like Hulk? Somebody's with the one up to your video. You need a Hulk video next time, Jayson.
So here's a couple of questions. How many vehicles have you and your family purchased up to this point in your lifetime? Whether you paid cash, leased, or financed. Go ahead and type a number into the chat window. I'll get it started. My number is 6.
4, 8, 4, 2 to 3, 7, 4, 6, 5,
Okay, let's get a few more.
4. It's got about an average of, it's got 8, 15 plus.
Oh, wow. Okay, so we're up to what, about 60 so far?
Yes, we would be, yeah.
So let's say the average purchase price of the vehicle is what? I'll just pick a conservative number. Let's say the average purchase price is $25,000. So we've got 60 vehicles, 25,000. That's 1,500,000 that's been permanently transferred away. And that's just with a fraction of the attendees on tonight's webinar. My question is, how many more vehicles are you and your family planning to buy for the remainder of your lifetime? The answer is many. And people are likely to spend more money financing cars throughout their lifetime than they will ever save for retirement. I want you to just reflect on that. Now, I want to use this example quickly to demonstrate the process, the golden rules, and understanding how this all comes together. Back in September of 2017, I decided to purchase this exact vehicle, a Ford Explorer limited edition. It was $55,000. Now, when I made that decision to buy, I had purchase options. I could have paid cash. I could have financed it. I could have leased it, or I could have implemented the process of becoming my own banker. Now, the choice that I made is obvious, is that I chose to implement the process of becoming my own banker. Now, here's how that played out for me. I capitalized my system of policies, right? Remember Nelson's golden rule, don't be afraid to capitalize. Your money must reside somewhere. So I was putting premium into a system of dividend paying participating whole life insurance policies. I requested a policy loan for $55,000. Remember the golden rule, don't do business with banks. I utilized my cash value as collateral for the policy loan. Now, when I requested the loan from the insurance company, they asked me 2 questions. Would you like the money electronically deposited into your account, or would you like us to mail you a check? There were no lengthy, nosy credit applications. There were no fat cat bankers to deal with. There was no verification of income. It's an unstructured loan. So when they issued the money, they have no expectation of repayment until death. I'm the one that controls the repayment schedule of my policy loans. Isn't that good? The insurance company, what they did is they placed a lien on the death benefit for the loan balance, while 100% of my total cash value kept rising every single day, uninterrupted inside of my policy. So I'm like an Uber driver. I get paid, but I don't have to pick anybody up. And my vehicle is a depreciating asset. My policy is an appreciating asset. I achieved my objective of buying the car, and I still have all the appreciation inside of my asset while this car is depreciating in value. And every payment that I'm making is a payment back into my own system, not someone else's. So every dollar that I put back in, I get to reuse again. Doesn't matter what the interest rate is. I get to reuse everything I repay. The interest rate doesn't matter to me. What matters is where the money is flowing to and who that money is being put to work for. Isn't that good? Now, I control the repayment schedule, and I decided to repay my policy loan at a rate of $1,066 a month for 60 months. Don't steal the peas. I'm replenishing my shelves with more cans of peas, yeah? That's what I'm doing as it relates to my policy. I'm restocking the shelf with high quality merchandise, which in this case is money. Now, heaven forbid, if something happens to me, my family not only receives the death benefit of the insurance policy, the loan balance is wiped out and they still own the damn car. That's thinking long range. That's replenishing the family with all the money that would have otherwise been transferred away from the family. Now, where did the money come from to buy the car? It came from the life insurance company. Who owns the car? I do, free and clear from day one. Who's got all the money? I do, inside of my policy, still growing. What happens if I choose to stop or modify my policy loan repayment schedule? Nothing. The insurance company is not going to call me and ask me, hey, why did you stop making a policy loan repayment? They don't care because the insurance company itself is guaranteeing the collateral for the loan. So they know that there's no risk of default. How much of the money that I put toward policy loan repayments can I use again? All of it. Yeah, I get the car, I have all the money, and I recapture all the interest that I would have otherwise paid to someone else's system. If you can do this for cars, is there anything that you can't do it for? Rethink your thinking. That's the fifth golden rule. I'm going to ask everyone on the webinar this question. Type Y for yes, N for no. If you can do this for cars, is there anything that you can't do it for?
Getting some no's, Jayson. Yeah, all no's.
All right. Now, when I access a policy loan, do I have to pay interest? The answer is yes. I'm a co-owner of a life insurance company that provides me with guaranteed on-demand access to capital. And I have access to whatever could have otherwise been lent using my policy as collateral. Capital has a cost. But what I want to impart on everybody, because your consumer brain, not your banker brain, your consumer brain is going to fight you on interest rates because you've been conditioned to focus on rates. Bankers are conditioned to focus on volume. Isn't it interesting that commercial banks are making the most profits they've ever made in the lowest interest rate environment we've ever experienced in our generation, in a lifetime, since banking has been a business? The reason is that there's a higher volume of borrowing, a higher volume of repayment. So what is so important for you to remember is the four characters in the financial play. When you put money into the policy, are you a depositor? Yes. When you access policy loans, are you a borrower? Yes. When you request a policy loan on demand, are you the banker? Absolutely, because you're the policy owner and you're in a position of total and absolute control. And your policy has a guaranteed loan provision. When you repay policy loans with interest and the insurance company declares profit and distributes that profit in the form of dividends, do you as a policy owner receive a dividend every single year that it's declared? The answer is yes. So you become all four characters in the financial play. And if you contribute more to the earnings of the company that you co-own, do you receive a greater share of the divisible surplus? The answer is yes. Isn't that good? I want to ask this question, and I won't pause for the response, but I encourage you to type it into the chat window. Was there anything stupid about me purchasing the vehicle that way? Let me know in the chat window. All right. I want you to think about this as it relates to your own financial circumstance. Now, I want to talk to you about a different way of thinking about retirement. Personally, that word's not in my vocabulary, but I just want to give you a different way of thinking about retiring. In this example, we're going to talk about what the insurance company refers to as an insured retirement solution. Now, that's creative. Now, Nasia, pictured here, is age 45. Her objective was to have $39,000 in net annual retirement income from age 65 to age 90. She deposits $30,000 into her dividend-paying participating whole life contract for a period of 10 years. Her total in is $300,000. From age 65 to age 90, she's able to access $39,827 per year tax-free. Total out, $1,035,000. Nasia passes away at age 91 and leaves $586,000 to her named beneficiaries, income tax-free. Now ask yourself this question. Is it easier for Nasia to save $300,000 inside of her policy, or is it easier for Nasia to accumulate $1,035,000 inside of a mutual fund or of an RSP? The answer is obvious. It's much easier to save $300,000 inside of a unilateral binding contract that is guaranteed to accumulate value on a daily basis and cannot lose value. When the stock market goes down, Nasia's cash values go up. When the real estate market goes down, Nasia's cash values go up. When the government intervenes and increases taxes and reduces your disposable income, Nasia's cash values go up. I think you get the picture. Your money must reside somewhere. What better place to have it reside than here? There's no such thing as having too much money in your own banking system. Now, if we think about investors or business owners, we deal with a lot of investors, a lot of business owners. We speak to their accountants. We work with their accountants. Tim Dawson, who's a senior partner with Myers Norris Penny, was kind enough to leave a testimonial as it related to his own experience, his own knowledge in developing this understanding of this tool and this process. And he goes on to say that he wouldn't hesitate to put Jayson, and he's gone on to say our entire team, in front of anyone, and that we really are truly experts in this field. So we're very grateful, as always, for Tim's testimonial. Now let's talk about this business owner, Dylan, who's age 45. His objective is to have $41,000 in net annual retirement income from age 65 to age 90. His corporation deposits $50,000 into a corporate-owned, dividend-paying, participating whole life policy for a period of 10 years. The total in $500,000. The corporate tax on the daily cash value growth in that policy is zero. I say that again, it's zero. Now, I haven't met a corporate owner yet, or an individual or a household, who's ever said, wow, I really don't feel like I'm being taxed enough. The passive investment income tax is zero. From age 65 to age 90, Dylan accesses $41,005 per year after tax. He gets out $1,066,000. The corporation put in $500,000. So who put the money in? The company. Who spent the money in retirement? Dylan. Dylan passes away at age 91. The net death benefit is $806,000. So the corporation is replenished with everything that it put in plus more. And Dylan's death gives rise to what's called the capital dividend account inside the corporation. The capital dividend account receives a credit for $3.5 million. And so the surviving shareholders are able to extract $3.5 million in value out of the corporation in the form of tax-free capital dividends. Now, understanding that your wealth must reside somewhere, did this policy take away any of Dylan's options? Of course not. Now, I want you to go on and think about your children, your grandkids, your great-grandkids. I want you to think about developing a family banking system. Now, we've been taught up to this point to be divisive in the family. You may have all heard this at some point in your lives. When you grow older, you're going to move out, you're going to start your own family. You're going to have your own mortgage, your own bills. You'll understand. The wealthy don't talk that way. The wealthy talk about circling the wagons and keeping the money in the family. And you can achieve this. Now, this is a picture of our last family reunion. And Billy Bob here, he is no longer invited to any of our family reunions. You can see what ended up happening after he hung around for a few hours. We don't let him come back to any of our family reunions. But in all seriousness, in this picture, what you see here is my family. And we get together once a year and we have what's called our annual family banking meeting. And we talk about how we're utilizing our system of policies, the policy loan repayments that have happened throughout the previous year, how much capital we have access to, what opportunities have been tracking us down, how we can take advantage of those opportunities. And you'll recognize all the children. Now, this young fellow here, my son, Jackson, he was recognized in our most recent family banking meeting for having repaid his second policy loan. He was 12 years young in this photo. And children pick up on this process much faster than adults do because children have a much higher degree of neuroplasticity. That's why it's so advantageous for a child to learn a new language at such a young age, because their brains are more plastic than adults. The kids pick up on this way quicker. Now, what I do want to share with you, that's something that's so profound. So everybody pictured here is insured, in some cases several times over. We have 54 policies in our family banking system. By the end of this year, our annual premiums going into our system are $560,000 a year. We have clients that put in as little as $100 a month. We have clients that put in as much as high six figures every month. If you're somewhere in between those two numbers, you can do this too. And it's easy once you know how. Now, what I want to point out is this fellow here. This is Papa Habs. And sadly, he passed away in September of last year after a very short and aggressive battle with cancer. And when Papa retired from the Edmonton Police Service years ago, a few years into his retirement, I sat down with him and I said, Papa, I want to take out a policy on your life. I'll pay the premium, so you don't come out of pocket anything. And when you pass away, not only is Nona going to be okay for the rest of her lifetime, she won't have a bad financial day for the rest of her life, but we're also going to take a portion of that death benefit and we're going to put policies in place on all 9 of the grandchildren as part of your legacy. The only expectation that I have is I'm going to control the use of that policy while you're alive, and I want to be reimbursed for the premiums that I paid in when you pass away. He said, well, I don't think I'm life insurable. I said, well, why don't we find out? He was type 2 diabetic. So we applied, we got him approved. We put the policy in place with no expectation that he would pass away early. And when he did pass away, we fulfilled his legacy and we've taken care of that. And that's money that's come back to the family and is staying in the family. And so this is something that if you think about, all of you know someone who would die for you. And you know someone that you would die for. And so I want you to think about this as it relates to you and to your family. You can create this system so that you keep the money in the family, understanding full well that everyone in the family is going to pass away at some point. It's not a matter of if, it's when. And when that day comes, there's a windfall that comes back to the family and replenishes the family banking system. Remember Nelson's golden rules. Think long range, think 3 generations past your own. That's a sharp example of thinking 3 generations past our own. Don't be afraid to capitalize your system. Your money must reside somewhere. Don't steal the peas. Don't do business with banks, and rethink your thinking. That family banking system example is one that we receive so much feedback on that just resonates with people because we can all relate. We all need the use of money. Now, over the course of an entire lifetime, I want you to think about all the money that leaves your family for things like mortgages, investments, vehicles, property, weddings, taxes, tuition, business loans, insurance, personal expenses, business expenses, recreational vehicles, vacations, sports, hobbies. Add up all the money that you've earned and spent up to this point in your life. Can you write me a check for that amount of money right now? Type in the chat window a Y for yes and an N for no. Add up all the money that you've earned and spent up to this point in your life. Can you write me a check for that amount right now?
No, nope, no.
The reason is
I
that
wish.
the reason is that you've done all the work and everyone else has gotten your darn money. Even if you're debt free, you paid off all the debt, but you transferred all the money away. You can't earn interest on it again. It's gone. I want you to think about having the banking process work for you rather than against you. Now, you don't have to get a policy or a system of policies from us. There are many great people out there in the country that you can work with, but please don't try to do this alone. Households and business owners who do this right, they all have a good coach, and I recommend getting a coach. And I'm unabashedly going to say that I believe our team are the very best at this, that we are the gold standard in educating, coaching, and mentoring our clients from coast to coast on the implementation of this process. Now, think about Wayne Gretzky, one of, if not the greatest hockey player of all time. He depended upon coaches. Even at his degree of talent and skill, he depended on coaches to help him continually become the best version of him. And on our team, our coaches are absolutely incredible. And one of the things that I do like to share is, in addition to that, when you become a client, if you choose to work with us, we have a client portal, which is a password protected resource. It's a vault of resources for you that you can access 24/7, 365. And this is meant to help you truly become your own banker. And when you gain access to this valuable resource, we provide step-by-step instructions paint by numbers. So for example, hey, I want to understand how to access a policy loan. There's a short 4-minute video tutorial. There's a sample form to download. There's a blank form for you to fill in, to send that in. We're truly teaching you how to become your own banker. And through the creation of this resource and many others like the Banker's Vault YouTube channel, you can go there, subscribe to that channel. It's titled The Banker's Vault. There is just a treasure trove of video resources at your fingertips 24/7. You've got the Wealth Without Bay Street YouTube channel, which is all of our podcast episodes that we release every single week. They are all archived right here on the YouTubes. And so make sure that you take advantage of all those resources that we've built and created, especially for you. That's what we've done that for. It's no secret. I mean, whether, again, you make $10 an hour or $10,000 an hour, this is a process that you can implement. People like Ryan Nugent-Hopkins of the Edmonton Oilers, who, again, he's someone who recognizes the value of a good coach and understands the importance of continually improving. And that's what we do here so well. And when you choose to who you're going to work with, here's some things that I want you to think about. You've got to be careful about the life carrier that you put your policies with. And you need to make sure that your policies are designed properly. Secondly, most people who are selling you life insurance, they don't have expertise on the process of becoming your own banker, the infinite banking concept. They may have some rudimentary understanding of the tool, but they don't understand the process. So make sure that you work with somebody who specializes in the process of becoming your own banker. You should choose someone who is an authorized infinite banking practitioner with the Nelson Nash Institute. Now, here's what that means. It means that they've been through a curriculum of study, that they've been through a mentoring period, and they can demonstrate to you that they practice this process in their own lives. Very important to work with someone who is thoroughly familiar with this and how to implement it. Now, the reason you should do this in your life right now is because you deserve the outcome right now. The longer you wait, the more you penalize yourself. The real questions are, what's the cost of doing nothing? What's the cost of just one more year of all your money leaving your family or your business permanently? What's the cost of giving up all the interest that your money could have otherwise earned? Schedule your call with us. It's included with this webinar. You'll be glad you did. Now, here's a quick recap. The difference between you getting stressed or staying relaxed financially is who controls the banking function in your life. You don't have to put your money in financial prison for decades and rely upon someone else to achieve the financial abundance that you deserve today. You don't have to be rich to do this. You do not have to be rich to become your own banker. If you are already accustomed to banking, you're handling money as it relates to your needs, then you need to do this. Now that you've been introduced to the process and the advantages, you need to do this. And one of my colleagues that I referred to earlier, Brent Kessler, he said something so powerful in one of his live events. He said, I truly believe that once you've attained this knowledge and you do nothing with it, you're stealing from your own family and from your future family. You're allowing your money to continue to be transferred away from you. So don't allow that to happen. I want you to choose to advance, not retreat. Choose to advance. Now, you might be thinking to yourself, okay, well, this process looks awesome, but how will I know if this is going to work for me? Well, you've got to schedule your discovery call. Click the link that you received or text the word schedule to the number on the screen, 780-809-4599. Reserve a date and time that works for you. Now, again, if you book your call before the end of the webinar, here's what you're going to get. You're going to get a one-on-one conversation with an authorized practitioner on our team. You're going to receive access to an online video series through the Nelson Nash Institute that anyone else would pay $49.95 US for. That'll be our gift to you. You're going to receive a clarity meeting, which in and of itself is an incredible experience. And you may be thinking, okay, well, this sounds great, but I don't want to do this alone. Don't worry, you won't be left alone. You receive lifetime mentoring. We have quarterly group client coaching sessions. In fact, our next one is coming up here this Saturday. And we invite our clients to participate in these sessions once every 3 months. If you can't make it, that's okay. They're recorded and archived inside of our client portal, and you can go back in and review them 24/7, 365. There is no other organization in this country that has put together the content and the resources that we have, especially within our client portal. That's one of many things that makes us so sought after in the marketplace. All of the resources that I shared with you earlier are all available at your disposal. If you haven't already, go to nelsonnashfilm.com and make sure that you watch the 1-hour documentary film that I had commissioned on Nelson. And that'll give you an even deeper glimpse into the essence of just how incredible this man was. Again, it's available at nelsonnashfilm.com. There's no cost to view it. We also have another resource called dayofnelson.com. Again, that's dayofnelson.com, where we spent 11 hours interviewing so many people that Nelson had an impact on. And you'll hear stories, you'll hear us reminiscing and pick up some really, really good golden nuggets of wisdom as well, because there's some archived footage of Nelson teaching at that link. So go to dayofnelson.com. All right. Now, we are privileged to have received up to this point, we're north of 287 5-star Google reviews on the Googles, the internets, and we're very grateful for that. And I want to ask you this question, and I'd like you to type the response into the chat window. Y for yes, N for no. If all this process did was keep more money in your family or business, would it be worth it?
Lots of yeses, Jayson.
If all this process did was create a peaceful, stress-free financial life, would it be worth it?
Yeses are still coming.
Here's the power in commitment to yourself. You all committed earlier. You committed to discovering this process. You committed to improving anything that you're already doing financially that is preventing you from implementing this process. Now, you do have options. The first option is do nothing, and nothing changes. Remember, whatever you decide not to change, you choose. You'll continue to work your butt off for the banks, and everyone else will get all your money. The second option is schedule that call, take hold of your personal finances, and put control back in your hands. If you're committed, if you're truly committed, what would you do? Are you committed? Give me a Y for yes or an N for no.
Unanimous yeses.
Excellent. I want you to picture a day. I want you to picture a day when financial control is in your hands. Not the banks, not the government, not some temperamental market. Picture a day when financial control is in your hands. Picture a day when your spouse leans over and says, thank you. Thank you for not making me wait 30 years to enjoy the lifestyle that we want today. Picture a day when your finances are exactly where you want them to be. And you know with certainty that you have the freedom, the cash confidence to travel whenever you want to travel, relax when you want to relax, serve when you want to serve. Now, here's another thought. I'm going to leave you with this. I'm going to date myself now. I'm going to take you back to when I was 24 years young. This is in August of 1998. I had all my belongings packed in my Chevy Beretta, and I was ready for that 3-day drive from Timmins, Ontario to a new life in Edmonton, Alberta. Now, standing in the foyer of my father's home, he wrapped me in this big bear hug and he said, son, I'm really proud of you. Drive careful to Edmonton and don't get any speeding tickets, and make sure that you call me when you get there. I got pulled over by the RCMP right outside of Winnipeg, got my very first speeding ticket. And when I arrived in Edmonton, I didn't call home. I got straight to work. And about 3 weeks later, I was sitting down to dinner with my teammates, and I remembered to call my dad. So I excused myself from the table and I went, picked up the phone and called, and my stepmom, Beverly, answered. And I said, hey, can I talk to dad? And she said, well, he's in the bathroom right now. Do you want to wait? I said, no, thanks. I don't have a half an hour, but let him know. I apologize that I didn't call sooner. I did get a speeding ticket, but I will catch up with him as soon as I can. Now, the very next morning, I was paged to pick up an urgent phone call. And when I picked up the phone, it was my stepmom, Beverly, and she was frantic. She told me that my dad had passed away suddenly and unexpectedly. And of course, I was devastated. Now, I know it's human nature to procrastinate and to think that there's always going to be time. But what I learned is that you can't wait. When my dad died unexpectedly, I felt lost. I felt full of regret, and I felt like I had let him down. Since then, I've dedicated my life. I've dedicated my life to helping people just like you, to live a life that's fulfilling now, so there are no regrets later. You deserve a life of no regrets. You deserve to be in control of your financial future. You deserve a lifetime of abundance. So join me now and let's get you the life that you deserve. You made a smart decision to be here this evening. And with that, I'm going to go ahead and open it up. We'll do a little bit of Q&A, respecting the use of everyone's time. We got started 2 minutes past our scheduled start time, and we ended 2 minutes past our scheduled ending time. But I do want to open up and let folks know we're going to stick around for a few minutes, go through some of the questions. And so if you're available, please don't hesitate to stick around. If you need to go, we understand that too. But with that, Liz, why don't you hop on to video, and why don't we work through a couple of questions and maybe spend the next 5 minutes or so doing that.
Yeah, awesome, Jayson. Thank you. So first question out of the gate that was asked tonight was, I'm retired. Is this something that works for me? Could work for me?
You're still going to need the use of money throughout the remainder of your retirement. So the answer is a resounding yes.
A question about don't steal the peas, meaning how does it relate if you're borrowing money from yourself to buy a car, have a car loan? Should you be paying it back to the insurance company? How does that work?
Definitely. So whenever you borrow capital and you're all four characters in the financial play, you want to make sure that when you access a policy loan, you have your own schedule to repay it, because you want to replenish the merchandise, the money. You want to replenish your system so that your needs are met and so that others can prosper as well.
What happens if I live past age 100?
Well, I would say that you're going to be in good company, because the fastest growing segment of our aging population are centurions. So what would happen is, if you lived past age 100, the policy would be fully endowed. So the contract would be fully performed. So you would have an option to receive the death benefit proceeds or to leave them on deposit with the insurance company. And the insurance company would be sending you a monthly income for as long as you're alive. And then when you pass away, of course, your surviving heirs would be able to access the remaining death benefit proceeds income tax-free.
Awesome. So there are lots of questions about, we did talk about this earlier, but lots of questions about, can I use it to invest in stocks or crypto or other things as well?
Definitely. Think about this as an aquarium of capital. And from that place, you can do all of the things that you set out to do financially, whether it's investing, buying a business, expanding a business, purchasing the new car, paying for the wedding, for the post-secondary education. Think about all those things that you've already been spending money on up to this point in your lifetime. And now put yourself in the driver's seat where you're controlling the banking function as it relates to those needs. And your pool of financial value keeps going up every day uninterrupted while you're taking care of and meeting all of your financial objectives, whether they're personal or whether they're corporate.
So there were quite a few questions about policy loans, Jayson, and one of them was, can we just pay the interest on the policy loan, given it's simple interest, and then choose when you start to pay back the principal?
The answer is yes. When you access a policy loan, because you're the policy owner, you have full contractual authority over how, when you repay that policy loan, with the exception of your death. Once you die, the death benefit extinguishes whatever remaining loan balance there is, and then the residual death benefit that's left over is paid to your named beneficiaries income tax-free. But while you're alive, as it relates to policy loans, you're in a position of total and absolute control.
Awesome. And some people have asked questions around line of credit. What's the advantage of using a policy loan over a line of credit? You kind of just answered that a little bit then.
Yeah.
But, people still a little bit ideas around rates and what will work over time, but what are the advantages of policy loans over lines of credit?
Who's getting the money and who that money is being put to work for. When you borrow capital from a commercial bank, regardless of the rate, when you repay, that money is being put to work for the bank owners, the stockholders, and you've permanently transferred it away from you. When you repay policy loans, you're putting the peas back on the shelf of your own grocery store. So remember, the grocery store example, so important. And with our remaining attendees, I'd like to get, if I may, and I'm just, my apologies for pausing here, Liz, for a moment. I just want to invite the remaining attendees on a scale of 1 to 10. So 1 being you wished that you had been doing something else tonight and you'll never get this time back and it was a complete waste of your time. Or 10, you got a lot of value out of tonight. Go ahead and type a 1 through 10 in the chat window. Let us know what, there we go. Thank you, Morgan. Kent, okay, Kent, we got a 5. Not sure what it would take for us to get you to a 10. Okay, we got 8, 10, 8, 7, 10,000. Wow, thank you. 10, second time seeing this, it's a 9, a 7.5. That's interesting. 10, 11. Wow, thank you. And Ken, I was absolutely encourage you, schedule a discovery call and let that the right advisor on my team know what would get you from a 5 to a 10. Oh man, resounding 10s. Awesome, good. We just want to make sure that you found this to be a valuable use of your time because we respect your time. Any other questions, Liz?
Yeah, for sure. And guys, if you can put your questions into the Q&A, just that they get lost in the chat box. So just to make sure we get everybody's. Somebody else was asking, can the interest that for a policy loan ever get to the point where it's greater than the growth in the policy?
No. So what would happen is the insurance company, long before, because you're only able to collaterally assign 90% of the total cash value of the policy, if the interest started to essentially get to the degree where the insurance company viewed it as a concern, then the policyholder, the owner of the contract, would be notified that they have to get money back into the system, otherwise the policy will implode. And so that's why it's so critical to recognize that the policy owner's behavior is far more critical than the behavior of the insurance company. And when you truly become your own banker, you're going to recognize that capital has a cost and that you certainly wouldn't be borrowing money from someone else's system with no intention of repaying it. So you shouldn't treat your own supply source of capital any different. In fact, you should value your own supply source of capital more so than anyone else's. And so remember, don't steal the peas. That's the key point. Because if you do that, there ain't no value in pointing the finger at anybody else. It's all on you. If you access policy loans and you don't repay them and you destroy the very tool that enables you to create and control this function, then that's all on you. You're the one that's accountable to that, nobody else.
Yeah, great, Jayson. And there were a few questions tonight that are a little bit more personal in nature to your own circumstances. So those questions are really great questions to ask an advisor when you book a call with them. What's the difference between having paid up additions, Jayson, and buying multiple policies?
Oh, wow. That's a really good question. Well, I would say that, if you paid up additions is one element of the policy that really accelerates the growth of the cash value and also receives its own dividends every single year that they're declared. And so the difference would be if we had a policy that had no paid up additions and we had one that did, the policy with the paid up additions is going to do better than the one without. And if you have a system of policies, every single policy is going to be designed to maximize the paid up additions. And so it becomes a function of how big your system becomes, knowing that each step of the way it's been designed properly. And so I would just say that it's just a difference of volume, really, if it's designed right.
Okay, there was quite a lot of questions around the age you need to be to qualify for one of these policies. So can you give us the age range?
Sure. So a policy can be put into place for a life insured as young as 16 days old. So that would be for an infant, a newborn, and issued to a maximum issue age of 85. Now, the good thing is that you don't have to be the life that is insured. So we have many grandparents, great grandparents who are past age 85, and they choose to implement this process. So they take out a policy on their children, their grandchildren, or their great grandchildren. And so there's, for the most part, the vast majority, where there's a will, there's a way.
Awesome. What's the difference between using an RRSP or using this for a retirement solution?
Oh, wow. That's an excellent question. So when you have money inside of a tax qualified plan, like a registered retirement savings plan, the only way for you to begin accessing it is to begin depleting the asset. So you have to withdraw the money, you have to deregister it in order to spend it. Whereas with the policy, you borrow against the value that keeps accumulating while you're in retirement. So the question to ask yourself is, do I want an asset that is going to be depleted or one that is going to continue appreciating? And with the RSP, remember, whomever has the gold makes the rules. So the government can change tax rates, can change withholding tax rates. All of those are factors outside of your control. The RSP is a creature of the tax code. The participating policy has been in existence long before Revenue Canada even came to be. It is not a creature of the tax code. So if tax rates go up to 80%, it's not going to have a bearing on you if you are a participating policy owner and you're planning to use this as an insured retirement program. Isn't that good?
Awesome.
The only loser in that scenario is the government.
That's right. So a question around which insurance companies that we deal with.
There are several. We don't typically like to run commercials for any one particular insurance company. What I will say to you is that when you're working with the right person on our team, Liz included, she's absolutely incredible in how she practices this process, and she practices what she teaches. She does this in her own personal life, along with every one of our advisor teammates. And when you connect with them and you go through the process and you establish a basis to work together, the advisor is going to determine which company, which policy design is best to achieve your personalized financial objectives.
Awesome. Questions around, can we use this in a corporation and use it to fund a range of business or investment expenses?
You sure can. And it would be your greatest advantage to do so. Because just think about, this passive investment income tax and, these surplus retained earnings, corporate dollars that corporations are investing and paying a minimum of 50% tax on the gains generated from those investments versus flowing the money through a corporate-owned policy or a system of corporate-owned policies and paying zero tax on the daily cash value accrual. And the growth in these contracts is massive when the contracts are designed properly. And so if you're a business owner, please do yourself a favor. I understand that you're busy running your business, much like we are, but business owners make time for the things that they find to be important. So if this is important to you, schedule a call, get with the right advisor on our team, and you will be amazed at the advantages that this represents to you corporately.
Yeah, that's awesome.
All right, let's do one more.
Okay, one more is the gain inside the policy tax-free?
The gain inside the policy is tax-free as long as the policy is in force. And if the policy owner, remember again, the policy owner's behavior is far more critical than the behavior of the insurance company. If the policy owner at some point wakes up one morning and says, I want to forfeit this policy, and the insurance company is going to buy it back from you for the total cash value minus any loan balance, you could trigger a taxable gain because you could get back out more than what you ever put in. So that's why it's so important. You got to work with somebody who is thoroughly familiar with these instruments, this tool, and how to utilize it properly. And on our team, we bring all our resources to bear. So it's an excellent question, but if implemented properly And if you're a good steward, if you're a good policy owner, that wouldn't happen.
Thanks, Jayson. That's awesome.
That's good. All right. Well, everyone, thank you. Thank you for being with us. Thank you for hanging out in the Q&A. Make sure that any questions and lingering thoughts that have come up for you, those will be answered when you meet with an advisor. So take advantage of that opportunity and make sure that you get to clarity. And I look forward to connecting with you all. I look forward to hearing your feedback. And be sure to subscribe to those YouTubes. Go to the Banker's Vault, go to Wealth Without Bay Street on the YouTubes, hit the subscribe button. New content coming out all the time.